Hello, my name is Antariksh Tiwari. I'm a first year student at IIM Trichy. As a part of my Indian Economy and Policy course, I'm here to speak about the capital markets in India. Stock exchanges play a critical role in the growth of capital markets, with infrastructure platforms like clearinghouses, depositories, stock exchanges, and commodity exchanges standing as the pillars in the financial markets. It is through stock exchanges that capital markets are able to trade with efficiency, adopt adequate risk management measures, establish transparent communication channels to benefit all stakeholders. Deepening of the capital market can come about by integrating the regional exchanges with the national level exchanges, leading to higher yields, diversified risk, and improved efficiency. Dematerializing of shares by depositories and the initiation of online stock exchanges has helped to increase the accessibility of capital markets to the average investor. Most of the trading in the Indian stock market takes place on its two stock exchanges, the Bombay Stock Exchange and the National Stock Exchange. The BSE has been in existence since 1875. The NSE, on the other hand, was founded in 1992 and started trading in 1994. However, both exchanges follow the same trading mechanism, trading hours, settlement process, etc. At the last count, the BSE had about 4,700 listed firms, whereas the NSE had 1,200. Out of all the listed firms in the BSE, only 500 firms constitute more than 90% of the market capitalization. The rest of them consists of highly illiquid shares. Almost all the significant firms of India are listed on both the exchanges. NSE enjoys a dominant share in spot trading with about 70% market share and a lead in derivatives trading with about 49% market share versus 45% for the BSE. Both exchanges compete for the order flow that leads to reduced costs, market efficiency, and innovation. The presence of arbitrageurs keeps the prices in the two stock exchanges within a very tight range. Stock exchanges have witnessed a steady rise in the number of participants offering depository services and spreading access to an increasing number of cities. In the case of mutual funds, units of mutual fund schemes have been allowed to transact through registered stockbrokers of recognized stock exchanges. This trading also proves to be a huge benefit for the investor. This mode of trading is gaining popularity with the potential to reach out to investors in smaller towns and cities. In an effort to integrate trading activities in India with global capital markets, emphasis has been laid on instilling transparency and disclosure norms for the benefit of customers. Providing the investor with all available information is one of the key aspects that the stock exchange focuses on. Reforms in the securities market. There have been significant reforms in the regulation of the securities market since 1992 in conjunction with the overall economic and financial reforms. A key element of the reform strategy was building a strong independent market regulator. The SEBI Act, which came into force in early 1992, established SEBI as an autonomous body. The apex capital market regulator was empowered to regulate the stock exchanges, brokers, merchant bankers, and market intermediaries. The Act provided SEBI the necessary powers to ensure investor protection and orderly development of the capital markets. The introduction of the free pricing in the primary capital market has significantly deregulated the pricing control instituted by the erstwhile CCI regime. While the issuers of security can now raise capital without seeking consent from any authority relating to the pricing, the issuers are required to meet the SEBI guidelines for the disclosure and investor protection, which in general covers the eligibility norms for making the issues of capital, at par and at premium by various companies. The freeing of the pricing issues led to an unprecedented upsurge of activity in the primary capital market as the corporates mobilized huge resources. However, it did expose the inadequacies of the regulations. In order to address these inadequacies, SEBI strengthened the norm for public issues in April 1996. Clearinghouses have been established by the stock exchanges, and all transactions are mandatorily settled through these clearinghouses and not directly between the members, as was practiced earlier. The practice of holding securities in physical form has been replaced with dematerialized securities. And now, the transfer is done through electronic bookkeeping, thereby eliminating the disadvantages of holding securities in a physical form. There are two depositories operating in the country, the NSDL and CDSL. The margin system, limits or intraday trade and settlement guarantee fund are some of the measures that have been undertaken to ensure the safety of the market. The trading and settlement cycles have been significantly reduced. The cycles were initially shortened from 14 days to 7 days. The settlement cycles were further shortened to T+3 for all securities in 2002. The cycle is currently T plus 2. The last few years have seen significant interaction with the international capital markets. A major step towards that was the inclusion of the foreign institutional investors such as mutual funds, pension funds, and country funds to operate in the Indian markets. As a quid pro quo, Indian funds have also raised capital in international markets through issuance of global depository receipts, American depository receipts, euro convertible bonds, etc. Derivatives market. One of the most noteworthy achievements of the Indian capital markets over the past 17 years has been the development of the derivatives market. It has significantly enhanced the sophistication and maturity of the market. In India, derivative trading began in June 2000 with trading in stock index futures. By the fourth quarter of 2001, each of India's two large exchanges had four equity derivative products: futures and options for single stocks and futures and options for their respective stock indices. The NSE had become the largest exchange in single stock futures in the world, and in 2014 it ranked fourth globally in trading index futures, a sign of evolving and maturing market. Technology in stock markets. The advent of technology to the markets has been largely attributed to the National Stock Exchange. NSE introduced the screen-based trading and settlement system, supported by a state-of-the-art technology platform. To fulfill the commitment to adopt the global best practices and bring about more transparency to the capital markets functioning, SEBI also assumed the responsibility of monitoring the markets and stock exchanges. A significant step towards that initiative was the launch of Integrated Market Surveillance System in 2006. The IMSS equipped the regulator to identify doubtful market activity. The IMSS's primary objective is to monitor the market activities across various stock exchanges and market segments, including both equities and derivatives. IMSS collects and analyzes data not only from the stock exchanges but also from National Securities Depository, Central Depository Services Limited, clearing houses, and clearing corporations. The RBI introduced the Electronic Funds Transfer System, the Reserve Bank of India National Electronic Funds Transfer System, or the NEFT system. The objective of this system is twofold. First is to establish an electronic funds transfer system to facilitate an efficient, reliable, secure, and economical system to transfer funds and clearing in the banking sector throughout India. Second is to relieve the stress on the paper-based funds transfer and clearing system. In 2010, National Payments Corporation of India launched the Immediate Payment Service, or IMPS, an instant real-time interbank electronic funds transfer system. Unlike NEFT and RTGS, the service is available 24/7 throughout the year, including bank holidays. Debt markets. The debt market in India, especially the corporate bond market, is yet to establish a firm foothold in the Indian capital market. There is huge potential for expansion in the debt markets, with investment demands for infrastructure ever increasing. Some challenges that have prevented the bond markets from picking up the pace of characteristic of equity markets are low retail participation, small size of issuance, cost of issuance, and small investor base. A well-developed bond market is key to economic growth, enabling the long-term financing of infrastructure, housing, and private sector development. The debt market of India remains underpenetrated with very low participation from the retail sector, and efforts need to be channelized in educating and creating awareness among the investors. In spite of a well-developed regulatory and financial system, the corporate bond market in India is only 3.3% of the GDP, whereas the share of corporate bonds to GDP is 10.6% in China, 41.7% in Japan, and 49.3% in Korea. Favorable interest rates in India have succeeded in drawing funds from foreign investors in the corporate debt market, while participation from mutual funds and other investors for a short term of 1 to 3 years is also picked up. Another boost to trade has been a mandate by SEBI, which has mandated that all trades in corporate bonds would have to be cleared and settled by a clearing company to eliminate counterparty risk and increase liquidity. Commodity derivatives market. The commodity derivatives market in India is just coming out of hibernation. The current phase of consumption-led economic growth implies a growing demand of commodities. This necessitates the use of commodity derivatives and derivatives exchanges for increasing market efficiency and true price discovery. Equity market movement is influenced by domestic and global growth, expected corporate performance, changing political environment, and expected policy changes. Commodity markets often act as a defense to the fallout in the above areas as well as in expected changes in commodity output, agriculture, and weather. However, in India, FIIs play a dominant role, and like the equity market, can influence the commodity market also. The current surge in commodity markets needs to be viewed in the right context. The emerging need for trading in commodity derivatives is the result of investors wanting to trade with minimal costs with high efficiency. The commodity exchange ecosystem is expected to evolve to meet these requirements. I think the time is right to roll out more stock exchanges to cater to our growing capital needs. In particular, encourage setting up of trading platforms at, at existing stock exchanges in the securities of SMEs. SEBI has also taken several proactive measures to improve the integrity of the secondary as well as primary markets through better governance and disclosure norms. However, certain emerging challenges as well as regulatory reforms are still on the radar for smoothing out of wider and deepening participation of market participants. Thank you.